All right, today we're tackling something that drives every trader crazy, getting stopped out of a trade only to watch it rocket in your direction moments later. We're going to look at why that happens and, even better, how a really simple tool can help you finally get a handle on market volatility and actually stay in the game.
Okay, let's just dive right in. We're talking about a classic situation that feels like a trap, because honestly, it kind of is. It's what we call the volatility trap, and I guarantee it's something every single trader has gone through.
I mean, does this sound familiar? You find a great setup, you put on your trade, you set your stop loss just like all the books tell you to, and bam, a crazy spike comes out of nowhere, hits your stop, and boots you out. And then, what happens? The price immediately snaps back and takes off in the exact direction you knew it would go. It's infuriating, right? So, here's the thing. What if that wasn't just random market noise or bad luck? A lot of the time, it's actually a deliberate tactic. It's called stop-loss hunting. And the good news is, once you see how it works, you can start to build a real defense against it. So here's the play-by-play. The big players, the whales, the giant institutions, they have a pretty good idea of where everyone, all the retail traders, are putting their stop losses. It's usually at those really obvious support and resistance levels, right? So what do? They can intentionally shove the price right into those zones to trigger that big cluster of stop orders. And all those sell orders create a huge pool of liquidity that they can use to fill their own giant positions at a fantastic price. It's kind of brutal, but yeah, your loss literally becomes their entry ticket. So how do we fight back against that? Well, we stop guessing and we start measuring. Instead of just being a victim to these wild market swings, we can actually quantify the market's, its mood, and start making decisions based on cold, hard data. And this right here is the tool for the job, the average true range, or ATR for short. Now look, most indicators are trying to tell you where the price is going. The ATR is different. It does one simple but incredibly powerful thing. It just measures volatility. It tells you how violently the price is swinging around over a specific period. And you really have to think of volatility as a double-edged sword. It's your absolute best friend when you're trying to hit a profit target fast, but man, it is your worst enemy when it comes to risk. That same energy that can make you a ton of money can wipe you out in a heartbeat if you're not careful. Okay, let's make this super practical. Imagine you're looking at gold and your ATR indicator says $30. What does that mean? It means that on an average day, gold is probably going to swing about $30 from its high to its low. That's it. It's not telling you if it's going up or down. It's just measuring the raw energy, the size of the playground for that day. Okay, great. So we can measure this energy now. The big question is, what do we actually do with that information? Well, when the ATR is screaming that the market is volatile, you absolutely need a playbook. And here it is. It's super simple. 2 rules. That's it. And they are non-negotiable. Rule number 1, you cut your lot size. If you usually trade 1 full lot, maybe you dial it back to half a lot or even less. And rule number 2, you widen your stop loss. You use the ATR to tell you how much wider it needs to be. And why do we do this? It's simple, really. In a high volatility market, the price swings are just bigger. They're more violent. That tight little stop loss that works great on a quiet day, it's going to get obliterated. You have to give your trade room to breathe. You have to give it enough space to ride out the noise without getting knocked out by some random crazy spike. And I really want this to sink in because it's a hard truth for a lot of traders. If you're trying to trade during a big news event with a tight 10-pip stop loss, you're basically just signing up to lose money. You are almost guaranteed to get stopped out. That volatility will find you. All right, but now for a really important point. We have to be clear about what the ATR is not. It's an amazing tool, but it's not a magic wand. It's a tool for risk management, not a standalone trading strategy. So let's just lay it all out. What does it do well? It is fantastic for gauging the market's mood, for understanding volatility. That helps us set smarter, more adaptive stop losses and figure out our position sizing. But here's what it doesn't do. It will never, ever tell you if the price is going up or down. It gives you 0 buy or sell signals. So think of it like this. The ATR is the seatbelt and the airbag in your car. It's there to keep you safe. It's not the steering wheel or the gas pedal. So I'm going to leave you with this one question to think about. Are you reacting to volatility or are you preparing for it? See, most traders just react. They get caught by surprise, they get stopped out, they get angry, and they lose money. But by using a tool like the ATR, you can switch from reacting to preparing. You can see the storm coming, you can adjust your risk accordingly, and you can learn to work with the market's energy instead of getting totally crushed by it. And really, that choice is up to you.